Ever heard of the option Greeks? Let's meet them. Why do we care about the Greeks? Well, believe it or not, understanding the Greeks can help simplify option trading. The option pricing model involves complex mathematics, but it can be simplified in practice. Of all the variables that impact the value of an option, there are three key variables that have the biggest impact on the value of an American-style option. These variables are price, time, and volatility. Well, trying to be right about all three variables at the same time just can't be done on a consistent basis. You'd have to be right about where's the stock going, when is it going to get there, and how much variation would there be in the price on its way there. As you can imagine, trying to be right about all three of those variables on a consistent basis at the same time is an impossible task. This is where the option Greeks come into play. The Greeks are pricing model outputs that allow you to measure a trade's sensitivity to the different variables that impact the value of the trade. Now, if you can measure the variables, you can adjust your exposure to them and thus increase your probabilities of successful trading. For example, if you were bullish on a stock and you thought the price was going to go up, and you were hoping to make money on the price of the stock moving up, you could use your understanding of the Greeks to minimize the impact of time decay and volatility on your trade and maximize your exposure to price movement. Or maybe you're not sure where the stock is going, but you've got a pretty good idea of where it's not going to go, and you're pretty positive that time is going to keep going by. Well, you could use the Greeks to minimize the impact of price and volatility and maximize your exposure to time decay in a positive way. The Greeks are the option trader's tools for increasing probability, maximizing profit, and minimizing risk. Understanding the Greeks is essential to your long-term success as an option trader.